Hello and welcome back to the Property and Lending Podcast show. If you're watching on video, you'll notice that there's a few heads missing today. And if you're listening in, you'll find out soon. It's back to the OGs, the two guys who actually do the work around here, and the other guys are missing. So I'm joined with Fadi, the director and head honcho at Power Loans. Mark Kilada, Peter Georgi, both Peter's in Fiji, Mark's exploring Europe, and all the work has been left to Fadi. Fadi, how do you welcome and how do you feel about your staff just ditching?
I think it would be a good process for Mark. I think he's traveling to try and find himself and how to share his feelings a little bit more better. I think everyone wants to know how Mark's feeling, but Mark's feeling pretty well now at Europe, and Peter's just enjoying his time in Fiji.
So they've left all the work for you. So you're very busy at the moment. I've got quite a bit going on as well. We've got a by the time this podcast goes out, it would have already happened. But tomorrow we're doing a presentation. We were asked to give a presentation at the Leppington Builders Expo, which is cool.
Yeah.
Just a half an hour on why invest in real estate, how to do so, and very brief, very quick chat there. So I mean, by the time this goes out, it would already happen. But if somehow someone knows about it, see you there. So we're both a little bit strapped for time, but we thought it's been a little while. We were supposed to do one on asset finance, but as mentioned, Peter's taken his private jet out to Fiji. So we're gonna talk about something that's been asked a lot recently, and you've had quite a few clients or customers using this technique. And then we'll discuss, from the lending perspective, and then the buying perspective, how it affects things. So what we're talking about is guarantor loans. So I guess we've had quite a few of them come up recently. I guess the first thing I ask is, really simply, if no one's ever heard of it, what is a guarantor loan?
So we've had, like you mentioned, we've had a lot of questions come through about 100% lending or 105% lending. So, 100% lending can happen in two ways. You can go through a guarantor loan. And what a guarantor loan is, it's a beautiful thing, actually. If your parents have any sort of house or any sort of asset in regards to residential, we are able to borrow against that house as long as there is equity in your parents' house to cover the guarantee amount that you're looking to get. In that guarantee amount, it's always going to be the case of 20% deposit, and it also covers the stamp duty cost and transfer costs as well that you can capitalize on top. And that's where it pushes it to 104% in regards to borrowing. And another way we can borrow 100% is something that I guess most of us know we see a lot of as well, especially if your existing customers are always coming through, where they're actually borrowing or taking equity out of their current property they would have purchased through First Brick for yourself. Equity has grown, they take the equity out and purchase their next property at 100%. And the way that works is you take the 20% plus stamp duty out of the current property, and then you borrow the 80% against the new property as well. So it's something that I guess, a few of our mutual clients, when we put those posts up, yourself and I, and a lot of people have been messaging or, messaging through our socials and like, oh, wait a minute, can we borrow 100% of the loan? Or how can we do this? So I think we both have got a lot of questions coming through. And I think we're discussing this morning how important it is to pretty much, put some more information out there in regards to how it all works.
Yeah, it's a good summary. And I guess the major takeaway from that is, people always assume you need to have stacks of cash to get into the market. And what you've just told everyone is you don't even have to have any money, essentially. Is that as simple as it is? Is it, if I said to you, Fadi, my parents have equity in their property, I can use their equity essentially, or their property to guarantee my loan, and I don't have to have any money. Do I have to have proof that I can save? What are the requirements for me to be able to get a guarantor loan?
So in regards to the guarantor loan, there's a few requirements that you would need. First off, obviously, if you do have some sort of savings, that helps because the bank also want to see that you're able to save as well. They're not just gonna give it a loan of 105% out unless we can show some sort of history whether that's through savings, whether that's through you're currently renting. So not a lot of people know this, but if you've been renting for more than 90 days, that actually shows 5% genuine savings. Okay, so in regards to if you don't have any cash, but if you can show that you've saved 5% or you've saved over a 3 months period, that's one of the requirements as well. So it's as simple as that. Obviously, when people are coming to see us, they show like, man, there's been so many scenarios. Again, it's such a beautiful thing where, we've got young couples that are coming through looking to purchase either their first property as an unoccupied property, or they're looking to purchase their first investment property and they've got cash flow in the bank, hoping to use towards either their wedding, towards holidays, honeymoon, children on the way, or any long-term plans. They're able to hold on to that cash flow and purchase their first property. So I think it's important to outline as well, you can only have a guarantor once, and that's only for your first property.
Yeah. Okay. Now, what are the implications for the actual guarantor? So for the parents or whoever is the guarantor in the scenario, is there a negative? Is there an impact to them? Is there what happens to their property? Are they put at risk to do so? If someone's thinking this when they go and tell their parents to have a property, or can you be a guarantor? What the initial question or the immediate question is usually, oh, what does it mean for me? What is it? So we've just said, if it was a $500,000 purchase, usually you would need 10 to 20%. So we're talking 50 to 100 grand plus stamp duty. So you're talking, between 75 and 125 grand. And with a guarantor, we don't need anything. We need zero. What does it mean for the actual person that's guaranteeing the property?
All right. So when we go out and see, guarantors, when we know it's a guarantor loan, obviously the broker needs to go out there and interview the parents as well to make sure that they're fully aware of, what's about to happen and how it all works. Now, first question we always ask is which lender they're currently with, or if their house is unencumbered, it kind of makes the process a lot more easier. Now, I'll start off, if the parents are to have a property with a loan on it, let's say, for example, it's $1 million property, they have $400,000 owing on that current property. If we're going for the same lender, so if the parents are with lender A and we're going with lender A as well, that lender will allow you to cash out that 20% plus stamp duty up to 80% of what the house is worth. 80% of $1 million is $800,000. So they've got $400,000 they can guarantee for their children. Now, for a $500,000 property, it's a 20% deposit, which is $100K, correct? I don't want to get that wrong on the internet.
Yeah.
Plus stamp duty and transfer costs. So you're looking at about maybe 145, let's call it $150,000 that your parents would have to guarantee as that 20% deposit in the stamp duty plus the transfer cost, which they have in that scenario because they've got $400,000 to guarantee. So now they've used 150 out of that. The great news about that as well, if they've got another child to go for a guarantor loan, that means they've got 250K left to guarantee for the other child as well. So you've got that wiggle space, And that's why I said if the parents are also, their properties are unencumbered, it kind of gives them, if they've got 3 or 4 kids, they'll be able to guarantee for those 3 or 4 children. Now, the biggest risk to the guarantor, and this is something that we emphasize, even by our customers or our applicants there in front of us, is that the biggest risk is if the kids or the applicants are going for the loan, stop making those repayments. The parents are the number one people they'll be approached in regards to covering that debt. And that's the main risk going towards the guarantors.
Yeah. Okay. So in that example, you just said there was $125,000 or $150,000 used to guarantee the purchase. Now, is that $150,000 actually physically? Is it like a refinance? Is that money coming out as cash, or is it just on paper that we're going to represent that $150,000 part of the loan?
Yep. So that's something I should have mentioned. So that 150K, the guarantors will not see on their side.
Yeah.
That is going to be the applicant's debt. So that's really done on paper, but the applicants are going to be owing. So for a $500,000 property, they're going to be owing about 540 grand. That will come up on the guarantees, which is the applicant's bank accounts. Now, for example, we've got a lender that, most lenders will allow us to have it under one umbrella. So you have the 540K in one loan. There may be 2 lenders out there that will have it as a split. They'll have the guarantor portion, which is the 20% plus stamp duty plus transfer cost as one split. and the remainder 80% as the other split as well. I don't know why that's done, but obviously each bank has its sort of policies. But at no time the parents would see that loan come up from their portal.
Yeah. Okay. So the parents are not affected during this. Their loan doesn't change if they have one. It doesn't become more expensive for them. It's the person purchasing is going to have obviously a larger loan than the purchase amount because you're obviously taking into account all the other costs as well. Now,
and keep in mind the way. Sorry.
Yeah. Go ahead.
I was going to say, just so keep in mind, the main question that comes from the parents and the guarantees, obviously, is when can we remove our parents as guarantors of that loan application? In this scenario, in most scenarios, as long as it's not an LMI territory, which is the lender's mortgage insurance territory, and that's the reason why we've gone ahead with the guarantor loan, so we can skip those costs, those extra fees involved as well. So once the property that is being purchased gets at 80%, which basically means you owe 80% to what it's worth, that's when we can actually remove the guarantors. And it's such a simple process where we'd order valuation through that current lender. Then they'll fill out a one-page form to pretty much discharge the parents of that title, because technically your parents are guarantors and are on that title as well. Technically.
Yeah. Okay.
Yeah.
That was going to be my follow-up question.
Oh, sorry. No, in scenarios where there's doctors and all that, or those professionals, like the professional packages where you can go up to 90%. Once they get to that 90%, as long as it's out of that lender's mortgage insurance territory, we're able to remove the parents as the guarantee.
Yeah, cool. So I guess a follow-up question to that is, because I know a lot of our clients ask this, is when the parents have been removed from the guarantor, so you've come down to this 80% LVR. Now, usually, for example, if I purchased a property and I put a 10% deposit, so I had a 90% loan, and then it got to a point where I was at 80%, there's some available equity. Now, when you are on a guarantor loan, because this gets asked a lot, and I find it trips people up and they get a little bit confused. You had 104% or 105% loan, and now we're at 80%. So we've removed your parents. So the value of your loan is 80% of the value of your property. At this point, usually there would be available equity for us to pull out. If you are on a guarantor loan, is it the same? Do I have available equity now? Or does it start counting? Does the available equity start counting from this point onwards?
The equity will be counted from when it hits to 80%. Obviously, in most scenarios, the banks will allow you to go up to 90% into LMI territory again. If it's for a purchase for a future investment opportunity, they'll allow you to cash out up to the 90%, including lender's mortgage insurance. Yeah. But there will be no equity taken out of that property as long as the guarantors are on there, and there is no equity available on there until the guarantors are removed. So that's a pretty strict rule. Yeah.
Can we'll run an example scenario? Let's say we purchase a property for $500,000 and we use the guarantor. So our loan was $530,000. Now, assuming you're not part of a professional package and you're releasing equity at 80%. Now let's assume the property hasn't gone up in value, just to make it really easy. And then we've paid off $130,000. And now our loan is $400,000, which is the 80%. The value is 500, the loan is 400. We've removed the parents from the guarantor loan. Do I now have equity that I can pull out, or does it start counting from today?
The equity they can pull out in that scenario when it's at 80%, the only time you can be, like most lenders, part of policy, the only time you can take out equity, because you're going to be paying lender's mortgage insurance, which kind of defeated the purpose of you going for a guarantor loan in the first place. But when you're going through that in regards to the equity, you can release equity up to 90%, including lender's mortgage insurance. So technically, the equity that's really given to you is up to 88. Let's say 88%. In some scenarios, we can push it up to the 88.25 to allow that space to capitalize the lender's mortgage insurance in there as well. If you're looking to pay for the lender's mortgage insurance upfront from your own pocket, then you can cash out to the 90% to use for your next purchase.
Yeah. But I guess my question was more so around the timing. So the same time we've taken off the parents is because we're at 80% LVR. can you also start to you can release equity immediately? So in this scenario, it's 500 property. The property is worth 500. We're at 400 now. That's 80%. We've removed our parents, and then the next day I can try and get equity out. Is that correct?
Correct. Yes.
Yeah, cool. Because we get a lot of questions, and it gets a little bit confusing around people. Does the equity start counting from when we've removed the parents, or is it just 80%? We've removed the parents, and you can pull out equity. So
As
in
long as
this
the parents
scenario,
are off there, yeah.
yeah.
As long as the parents are off there as a guarantor, yeah.
So that's a really good. I guess I have one more question about the structure, but that's a really good advantage if you really think about it. Is you're getting into the market with no funds up front, essentially. Even if you've got savings or whatever, and you've come into the market with no funds, and then the second you've pulled your parents off of the loan is also the same time you have available equity. So you haven't put anything into it to start off with. And then you've gotten to a point where you're at 80%, you've removed your parents, and then you have immediate equity that you can pull out to go again. So it's a really strong advantage to get ahead, especially if you have, if you don't have the funds at the start. It's a great way to get into the market. I was going to ask, is it only parents that can be a guarantor?
In most scenarios, you have to be the parents, because that relationship there, it's basically your parents. They're able to do the guarantor loan for you. And it's mainly for siblings as well. There are some lenders out there where allow, if there's a grandma, a grandfather, uncle and auntie, as long as they're okay to guarantee it, the lenders will allow for that as well. Yeah.
Yeah. Cool.
You have to just know that relationship as well.
Yeah. Yeah, for sure. Yeah. Now, I guess one of the major disadvantages that I encounter when it comes to guarantor loans is cash flow.
Yeah.
Now, people, especially with interest rates the way they are today, 6%, 7%, 8%. In one case, I heard of someone's rates at 9.5%, 10%, which is crazy. Rates are high, so your repayments are already high. When you're using a guarantor loan, I find sometimes our clients not fully aware of the cash flow implication. And what it is your property you've purchased for 500, and we're receiving, call it $500 a week rent. So that's 5.2% yield, which is unbelievable, right? It's a very, very good yield. But you actually have a loan of 540,000 or 530. So you're actually borrowing more than it's worth. So your loan amount, you have 100% plus 4, so 104% loan, and your rent is obviously not going to cover. In most scenarios, it's not going to cover your mortgage repayments, or usually not come close to it either. So it's very important to understand that if you're borrowing more, your loan amount is going to be more. And it is sometimes an unrealistic expectation to assume that we'll be able to get properties that cover a full 100% loan or 105% loan, especially when rates are really high. So it's just something to take note of and to be aware that everything has a pro and a con, right? There's positives and negatives, and you have to decide if this is the right thing for you. And that's why, it's important to speak to brokers like yourself who, are holistic and look at the full picture. Because someone might have $100,000 savings and looking at using a guarantor. I mean, you just have to understand, okay, if we use a guarantor, your loan's going to be bigger, which means your mortgage repayments are going to be bigger. But you're going to keep the 100 grand in your pocket, and you can put that in an offset account or something.
And the flip side, keep in mind, in regards to that scenario, then I think we both have seen this a lot, is that when the guarantees, which are the applicants, come through, they have such a large savings, but they go ahead with the guarantor loan. If they want to purchase another property afterwards, if they come back and say, KM, you know what, we actually do have funds with, we're looking for another great investment opportunity, we've actually got the funds there. It's actually another good way, especially a lot of the customers that come to you and they're like, oh, we're looking to start our investment portfolio. And, what's the fastest way that we can do that as well? If their first time it's their first time to enter the market, they can go with that guarantor loan if they have the option to. And a couple of months later, or whenever that loan settles, they're able to use those funds that they've got saved up to purchase another investment or property as well, which we both have experienced with our customers as well.
Yeah, for sure. So that's that's a massive positive, and like, yep, you can use a guarantor to get into the market, and that loan on its own you might be at 100%, 103%, whatever, and then using your cash on a separate loan, separate to the initial property, you can use that to get into the market if you have your 10 to 20% deposit as well. But it's just about understanding the implications of using a guarantor loan and not expecting the same results from a cash flow perspective if you're on an 80 or 90% loan. That all changes. It's all up and down. There are different implications. So it's just about understanding and being aware of that. When it comes to lending again for a guarantor loan, can you be guarantor loan and have an interest-only loan as well, or do you have to be principal and interest?
So ideally, in most scenarios, from a broker's point of view, you'd like to think you'd want to go on principal and interest repayments to get your parents off as guarantors as soon as possible. And going back to what you were just saying now, in regards to a cash flow, that cash flow is not going to improve on an interest-only loan because the loan's not going down. So in that scenario, cash flow is not going to be improving unless the rental goes up, the market goes up, the property worth as well. And you're not getting the guarantors off sooner than later, which allows you to also pay the loan down, have access to equity where your parents are no longer on there. So the guarantor being on there doesn't allow you to have access to those funds as long as the guarantors are on there.
Yeah. So most guarantor loans you will be running on a P&I. So obviously it's important to run that, take that into account with your numbers. Can you have an offset account?
You can have an offset account. You can even do interest only if it's an investment. If it's an investment, you can have interest only. Obviously, that's under the bank, but then you're not looking. So cash flow is not going to be improving under a guarantor loan on an interest only, and you're not getting the guarantors off there anytime soon. You do have access to an offset account if you choose to have one as part of the product that you go through the lender, and you can use those funds that you've currently got in the bank now to put into the offset account to offset basically the interest that you're going to be paying on that new purchase.
Yeah, for sure. So what are the steps, I guess, if I say to Fadi, I want to buy a property, I don't have much of a deposit, my parents have a property, can I use them as a guarantor? What's the process? Who do you speak to first? Is it the parents? Is it the banks? What's the process? How long does it take in comparison to a regular loan?
So the process would be, it's a pretty similar process. The only difference is that when we get the guarantors involved. So the beginning process is we take a look at the servicing for the customers, for the applicants that are coming through to see, how much they can service up to. So what the banks will allow them to borrow for the next purchase. Now they can, let's say for example, they're able to borrow the 540 grand, which basically means they could purchase a property for 500 grand and have the stamp duty and transfer costs capitalized on top, which takes us to the 105%. Once we know that figure of how much they can borrow, in this scenario, 540 grand, second step is now visiting the parents, taking them through the process, explaining the advantages and disadvantages of going down as a guarantor loan. And then we'll be asking the parents again, which lender are you with? What's the current loan? What's the current outstanding balance on your loan? Finding out, also valuation is also done on the guarantor's property to find out what the value of the property is. And here's another example. So we discussed before, if we're going through the same lender as your parents as lender A, and we're going with the same lender A, we can go up to 80%. But if your parents are with lender A and we're going with another lender, let's call it lender B, that lender may only allow your parents to go up to 60% LVR because they don't have security. So we're pretty much putting another bank is putting a second mortgage on another bank's security. So in most scenarios, those lenders are like, no, we're only going to allow up to 60% LVR because we don't actually hold that security.
Yeah.
Yeah.
Yeah, cool. Question that just came to mind. Can you guarantor or can you guarantee serviceability, not deposit? Right. So for example, I have 200 grand saved up, but my income is low. I don't know where I got 200 grand from, but I've got it. I've been saving for a long time, 20 years. I saved 20 grand, 10 grand a year. I got 200 grand. but my income is not good. Can I get a guarantor to guarantee my serviceability, or is it only for deposits?
You can. So you can actually have, it's now called a serviceability guarantor, but then your parents be going on the title as well. That means
Okay.
they're a shared party on the title, so there's an interest. So your parents would have to be added to the title, not so much on paper like it is with a guarantor loan, where you're able to
Yeah.
service it. This is now called a serviceability guarantor loan. And when it comes to serviceability guarantor loans, you're pretty much kind of left with the option of going to the same lender that your parents are with at the time as well to allow for that serviceability guarantor. And I think you know more than most in regards to trying to do a guarantor loan with a different lender than the parents are with. It's quite draining and pretty hard to get two banks to communicate with each other in regards to that sense. So in most scenarios, we try our very best as long as it fits the customer's profile, what they request in regards to their products and features. We always strive for stress levels or blood pressure levels on all parties to try and go off the same lender as the parents. Yeah. But that serviceability guarantor is definitely an option. Yeah.
Yeah. Is it used often or not really?
We don't see much of those. Man, I can probably say I've probably written maybe 10 in the last 5 years as a serviceability guarantor. And eventually when the guarantees or when the applicants, the kids are in a position where they are earning that sort of income, then we can look at removing the parent as the serviceability guarantor. But here's the kicker. When you're removing a parent off as a serviceability guarantor, you're now paying stamp duty to remove that parent off because that parent came on as a serviceability guarantor. They added to the title as a normal applicant. And then I've just actually had this scenario just recently. We then had to pay the person that was taking on the whole loan, which is, the applicant, the initial applicant, had to pay the stamp duty out back to the government. So in that scenario, we had to send the valuer out, a third-party valuer out to value the property. They'll come back with that report, and then you'll be paying half that stamp duty, or your parents can be going down. It depends on how much serviceability we need for your parents. We can either go down as a 5%. Parents can be down as a 5% on title, or maybe 50% on title. It just really depends on the servicing.
Yeah. Yeah. Okay. So that's interesting. So overall, there's a lot of positives to using a guarantor to get into the market. You can only use them once. They can help you get into the market. And if you've got cash, you can dump it in an offset, or you can use that to purchase another property if you wanted to. There are so many different aspects and different ways, different implications around it. So as always, speak to your trusted mortgage brokers at Power Loans, Fadi. Don't speak to the other guys because they'll just take your money and fly over the world and whatnot. But speak to them and look at it as a holistic approach and understand the positives and negatives to it.
I have a question for you.
Yeah.
I had a question for you, mainly because we deal with a lot of the guarantor loans at the moment. What's the biggest challenge when applicants come to you? And again, it's a question that always comes up, and it's fair. When it comes to investing, when you're purchasing an investment property under a guarantor loan, and that cash flow obviously is not going to be great as if you were to put your 20% deposit down plus stamp duty and have that 80% loan. How do you get past that? How do we explain that to customers where at the moment, if we're looking to get a guarantor loan, are we, I guess in your scenario, suggesting that we do go for the principal and interest payments where we can try and pay it down to improve that cash flow? Or how's it work? Like, how do you approach it?
Yeah, I think it depends on the person and their goals, right? And everyone is different. People have different risk tolerance levels, which is a big thing as well, especially with guarantor loans, because it's obviously you're taking on more debt than the property is worth. So that's obviously your first amount of, that's your first thing, is that some people are extremely risk averse and will, that alone is enough to make them not sleep at night. So that's something we discuss and we say, okay, well, in this case, we obviously want to be on a P&I and get the principal paid off as quickly as possible. But I think the biggest conversation is, well, you have two options. Well, this is assuming you have a deposit.
Yeah.
If you don't have a deposit, you don't really have an option, right? I mean, you do. You still have two options. You can wait, or you can use a guarantor. And in this scenario, it's usually better to just use the guarantor because we know, waiting, usually don't get in. You spend money on traveling, food, cars, whatever, and then you procrastinate. But if you use a guarantor, it gets you into the market, and so you're starting to make gains immediately. So in that scenario, usually we're just going, guarantor is a better option if you have the option and you understand the cash flow implications. Now, if you do have a deposit, say you had 150, 200 grand, whatever it is, and you had the option to use a guarantor, and people ask me, well, what's the better option? Oh, we run the numbers and we run some scenarios and we say, look, it really comes down to this, right? If you use a guarantor loan, you're going to have a bigger loan. Your cash flow is going to be poorer because you obviously got a larger loan. So you got a $530,000 loan as opposed to a $400,000 loan on the same property in two scenarios. So your cash flow is going to be poorer in one scenario than the other. But you've also saved, and I say saved in quotations if you can't see me. When you're listening on audio, I say it in quotations because you haven't saved it, but you have the 130 or 150 or $200,000 that you would have put accessible in your hand today, and then you've got option. You can put it in an offset account, so it's as if from an interest perspective you actually put the deposit down. So your cash flow will improve in that scenario slightly. Not your cash flow won't improve, but a bigger portion of your repayments is going towards your principal rather than the interest. So your principal is getting paid quicker, right? Which means you're going to bring that LVR down quicker. Or the other scenario is you've got that funds, and something you mentioned is you've got those funds, and if you wanted to purchase a second property or even a second and third property with that deposit, you could do so. So then we have a look at, we run the numbers on all the scenarios and we present it to the client and say, okay, if you went just the vanilla route, you put down a 20% or 10% deposit, this is what it's going to look like. That's it, clean. You put a 20% deposit, your equity is immediate, right? From the start, you've already got equity because you're at 80% LVR, and then, later on you can pull that out and, happy days. The other side to it is we've got the other scenarios where you've used the guarantor, and then we run the calculations on if we put the money in the offset, and then run the calculations if you purchase a second property, and we say, hey, these are the scenarios, these are the cash flow results for all three options, for example, and this is a forecasted capital growth result on the three options. Which one are you most comfortable with? Which one is clear in terms of who's going to make you the most amount of money? But it comes back down to, it's a mixture of what's going to make me more money and what am I comfortable with? What can I afford to hold on to week, things like that. So we run the scenarios and then we let our customers come up with their decision. But and that's why there's no black and white, because everyone's different. Some people happy to take on risk, happy to take on all the debt in the world, and then use their funds to buy more properties. And then all of a sudden you went from 0 to 3 properties really quickly because you use the guarantor and you use your deposit across 2 properties. Some people are like, no, that's all of a sudden I have 130% debt, 103% debt, 80%. I have all this debt. It's too much debt. Well, some people are like, I'll just put 200 grand on a 500 grand property, happy days.
Yeah.
So, 100 grand on a 500 grand property. Sorry. So we run the scenario based, and then we let our customers choose. But we go through all the implications, positive and negative, across all the scenarios, so they can make an informed decision in that scenario.
And again, we go back to current customers or customers that we've worked with in the past that have purchased those few properties in a row. It's like they've purchased those properties at 100% every time, because once they purchase the one or first 2 properties and they start growing equity, and then I think we saw a lot of equity growth during COVID, they were starting to purchase properties, investment properties, ongoing, using equity to purchase the next property, and then using equity out of that current property to purchase the next property, and still having funds in their offset account. So there's heaps of advantages in this. Obviously, there's a little bit of risk here and there. It just depends on what, like you said, the risk, how risk adverse you are. But it is a very interesting topic. And like I said, most of the posts that we put up in regards to guarantor loans, or if someone says 100% lending or 105% lending, like, what? Can we do that? Yeah. So, no, definitely an interesting topic. Yeah.
Obviously, you have to be able to service 105% loan. So that's one part to it. But again, always have a chat with Fadi and the team at Power Loans. And then, if that's all good, come to us and we can run some scenarios on, and then you can make a decision on how you want to play it. We're both running out of time. We both have meetings in like 3 minutes. So we'll wrap this up. If there is questions around guarantor loans, obviously speak to Fadi or myself, or let us know. We can have a part two to this podcast episode. Otherwise, thank you for listening as always, and we'll see you on the next one. If anyone has any topic requests, please send them through. And
hopefully we'll go from there. On next time for asset finance. He should be back from his gorgeous holiday next week. So
you can tell us how to fund a private jet.
Yeah.
All right. We will see you guys next time. Thank you.